Hi, I'm Patu from freefincal. Let's take a look at the daily returns of the Sensex and discuss why timing the market will work, but just not the way we imagine it to be. Now, the mutual fund industry has this propaganda that timing the market is not possible and timing the market is more important and so on. And that's just a way for them to tell us don't pull out your units, but the timing the market will work, and they themselves have many market timing funds. Any if you take any dynamic asset allocation fund or many balanced advantage funds, they all do market timing. They all take into account either our technical factors, technical parameters, or macroeconomic factors to determine the asset allocation in the portfolio. So it can be done. It's just that it's not going to give us the outcome that we want. The outcome that we want is to get more returns than the market, and it will. That it's more or less is a coin toss. We don't know when it will happen, when it would, but it's more likely to give us a lower volatility than the market. We can beat the market in terms of risk, but we cannot beat the market in terms of return all the time. And this is something that I've already established, and I've done several market timing tests based on Bollinger Bands, PE, double moving averages, single moving averages, and so on. I have an entire archive of this. So if you go to freefincal, if you see this free stuff for DIY investing, if you scroll, if you go here, you will see this market timing archive. That's the full archive. You can go to that, and that'll give you the entire battery of posts on backtests that we have done on market timing and so on. So what we're going to do here is to provide some context to all these statements that I'm making, and we're going to look at the price movements. Let me see if I've yeah, so that's what I wanted to say. Let's find out. So the first thing I'm going to show you is this Sensex. The Sensex is shown here in log scale, and then you have the negative returns that are 3% or less than negative, and less than that, that is 4%, 5%, and so on. And positive returns, which are shown in green, they are 3% or more daily returns. And notice whenever there is a positive return, there is a negative return. The huge positive return, there's a huge negative return that follows it. Whenever there is a small positive return, there is a small negative return. This is known as volatility clustering, and this is, I thank Siva from Asana Days of Wealth to point out what this phenomena is. Now, notice that there are I have some numbers for you here. If you look at this, let me show you. Let me just show you. Sorry about that. I got these tabs figured out. So in the previous graph, I had set a 3% limit. I had removed all returns which were less than plus 3% and all returns which are greater than minus 3% on the negative side. Suppose I don't do any kind of filtering, then this is what the full daily returns will show, will look like. And I've just taken the positive returns as marked it as green and the negative returns as red. And notice that you can see the clustering there. You can see how it huge deviations are clustered like this, and small deviations are also clustered in like that. Now there are something like if you look at the numbers, there are 9,431 total data points in this picture, and out of these 4,963 are green and 4,468 are red. It's pretty much 50-50. The good and the bad is pretty much 50-50. In order to if you want to try and time the market, for example, let's say you take the last 200 days closing price and you take the average and you create a plot out of that. That's called the 200 daily moving average, the 200 DMA. You can also take the monthly Sensex data and calculate the 10-month moving average. Both of them, 200 days and 10 months are moving average, are typically the same. We have done a backtest study on this. You can you can get the link from today's article. And in this backtest study, what we do is, so let's say if the price of the Sensex moves above the 10-month moving average, then we invest systematically in equity and also remove the debt and put it all in equity. And when the price falls below the 200 daily moving average, you sell all equity and put it into debt, and you also start investing systematically in equity. So you swing from 0% equity to 100% equity. You are in 100% equity when the current price is greater than the 10-month moving average, and when the current price falls below the 10-month moving average, you sell off all equity and put it into debt. That's the market timing model with the 10-month moving average or the 200 daily moving average. It'll be more or less the same. Now, if you take the so you can see that's black line is the 10-month moving average. Suppose you take this line similarly with 200-day moving average, and you did a similar daily returns calculation, you will get something like this. So here the blue line is the 200-day moving average. You can see it's a lot more smoother because of the averaging. And notice what happens to the volatility clustering. A lot of it is significantly disrupted. You have more number of green data points than red data points. However, you are not able to eliminate the clustering. See, for example, in portions like this, when there's a nice smooth upward movement, then there are no negative returns. You're able to get rid of the daily negative returns completely. But whenever there is a big fall, then whenever there's a big uptick, there's a big downtick as well. So that you are not able to eliminate the volatility clustering, but it is still there. For example, now if you look at the numbers in this picture, there are 9,232 data points, out of which 6,685 are positive. So from 50-50, you now have a majority of positive data points because of your averaging. Now, the big problem is there's always a catch in life. Notice that if you look at this, if you look at the swings of the actual index, the daily returns swing a lot. They go from 5%, 10%, 15% sometimes, and so on the both sides. But if you take the moving average and take the returns, then you can see the swing is significantly lower. The daily variations of the 200 DMA is like it's about 1% or even less on both sides, positive and negative. So you are suppressing both the positive daily returns as well as the negative daily. It's a uniform suppression. It's like a shotgun approach. You can't selectively say, okay, I'm going to suppress only the red data points. You can't do that. That is the whole problem with market timing. When you do a timing, you will do uniform suppression. You will kill both the good and the bad uniformly. And if you adopt a model that follows this 200 DMA strategy, your returns, the risk and the reward will typically follow the approximately mimic this 200 DMA line, and therefore your returns will also get suppressed, and your risk will also get suppressed. Of course, you can argue that sometimes your returns will be bigger because you are suppressing the risk. Yes, it's possible. Sometimes it's possible for you to get higher returns from market timing using this model or any other model, but you cannot eliminate the bad returns. Sometimes you get a good return, sometimes you get bad returns, and if you look at the back test, they will tell you it's pretty much a coin toss in terms of when you will get the good returns, because sometimes your sequence of returns will be such that you will end up investing in this period, then you will get good returns, you will beat the market. But sometimes when you hit this downturn, then you will get bad returns. So the sequence of returns risk cannot be eliminated, but what you are doing is overall you are suppressing both the good and the bad returns. Therefore, the volatility, the up and down movement of your portfolio will get significantly suppressed when you adopt a 200 DMA approach or a 10-month moving average approach. So that's what the market timing model does. It consistently lowers the volatility of the portfolio, but it cannot guarantee you higher returns. Sometimes you can get high returns, sometimes you may not get high returns. You don't know what will happen in future, and that's pretty much potluck. So that's why I said market timing will work. You will be able to beat the market in terms of risk more consistently, but beating the market in terms of return, just absolute return, getting absolute returns higher than the market, is pretty much a coin toss. It's pretty much down to potluck. You can't assign a probability to it. That's not how it works. So that's pretty much what I wanted to say. Let's find out what the market does tomorrow. Bye-bye.